Torsten, it is fantastic to see you here, even if we don't have the jobs data to talk about here today. Before we sort of dig into the big picture, I'm curious if you have any first blush reaction to the ISM services number that we just got, considering it came in a little bit weaker than estimated at 50.
Yeah, what's interesting about what just came out is that, yes, the headline number was a bit weaker, but at the same time, prices paid, meaning what are service sector companies paying for inputs into their production, actually went up. And at the same time, you also saw employment actually also went up. So this is telling you that maybe the inflationary pressures that are the biggest worry and has been the biggest worry in many FOMC mentors' speeches are beginning to show more signs of life, meaning that there are more risks still to the upside in service sector inflation. Because for a long time, the story has been very simple, that tariffs are mainly on goods. That's why goods inflation has been going up. But now the data that just came out suggests that we should still be watching very carefully what's going on with inflation in services, because now service sector inflation is going up. And remember, services makes up 60% of the CPI index, goods makes up 40% of the CPI index. So the higher rise in service sector inflation we just got right now a few minutes ago is suggesting that maybe inflation is going to be more sticky and more elevated.
It's also intriguing to me in this ISM report that the employment index coming in at 47.2, which is below 50, but still a little bit of an improvement. Given that we don't have the BLS data, I mean, how much importance should we put on that number, and what is that telling you?
No, this is very important because we are really flying in darkness at the moment, because the government data is absolutely of the highest quality relative to any private sector data. The challenge, of course, is that today we didn't get non-farm payrolls. We didn't get one side of the Fed's dual mandate, namely employment. And if this continues into the next several weeks, we will also not get inflation. And that makes it very difficult for the Fed when they meet on October the 29th, because then they need to make a decision without knowing the two very most important variables, namely what's going on with inflation and what's going on with employment. So the answer, Julie, to your question here is that it is indeed challenging for markets to figure out what is the true state of the economy when we don't have the highest quality data that we all normally spend so much time on.
Well, we might not have the highest quality data, but we have an awful lot of data that is out there. And you recently came out with a sort of assessment, right? You listed a lot of the other data sources. You tried to figure out, okay, which are the ones we should be watching. What did you come up with? What are you going to be watching most closely in the absence of getting stuff from BLS?
Yeah, this is also very important for investors at the moment, because if we don't get the government data, then exactly as you're saying, we need then to look, of course, elsewhere. And what are other data sources to look at? Well, one very important indicator is the Red Book same-store retail sales. So this is weekly data that measures what was retail sales last week relative to the same week a year ago. So that's telling you what were sales at Walmart, TJ Maxx, Target over the last week. So this is already a good indicator because it comes out every week, every Tuesday at 9 a.m. and tells you something about the health of the consumer. Other indicators, of course, are Open Table has daily data for how many people go to restaurants. You also have weekly data for how many people go to hotels. This comes from Star, a company in Texas. They report what is RevPAR, what is daily rate, what are occupancy rates across hotels across the country. So there is a broad range of indicators that you can also look at, including, of course, ADP, which we got earlier this week for the labor market, that will give you some idea about how the economy is doing. And these indicators are not perfect, but if you take them all together and put at the mosaic and the picture that they paint, we'll still give you some good idea about what is the direction that the economy is flying in at the moment.
Okay, so tell me then, given all of that, and given the government data just stopped, right, a few days ago. So what's your assessment, Torsten, overall? And I ask that even as you pointed out in one of your recent daily sparks, economists have to sort of take a good look in the mirror here, because not just this year, but for the past several years, your profession has been predicting some slowdowns that have not necessarily arrived.
And that is absolutely correct. And in particular now, we are literally today 6 months away from Liberation Day. And often you hear the forecast that, well, we're just waiting for the delayed negative effects of the trade war. Okay, now we are 6 months in. and we're still waiting. I mean, maybe Godot will not arrive, and maybe we will not have that slowdown that we all expected was coming as a result of what happened in April and May, where things, of course, were very turbulent. So maybe we should begin to come to the conclusion that maybe we're not going to see the economy slow down. And what's the consequence of this? Well, the consequence of this is that at the same time, we have upward pressure on inflation from tariffs. We have upward pressure on inflation from a lower dollar. Remember, when the dollar goes down, it becomes more expensive to buy my white shirt abroad. And if that's the case, then the price of my white shirt will go up. So that means that we have also inflationary pressure because of the depreciation of the dollar we've seen. And we also have inflationary pressures because of immigration restrictions. Deportations and immigration restrictions means that wage growth is starting to rise, especially in the sectors where unauthorized immigrants are concentrated, namely hotels, restaurants, agriculture, and construction. So taking these things together, if we already have from the consensus a forecast where the expectation from the consensus is that inflation will be 3% for the next 12 months, remember it's supposed to be 2% according to the Fed, that just brings down the conclusion, well, okay, if we at the same time do not have an economy that's slowing down, that means that the upside risk to inflation is even bigger. So in summary, the short answer to your question is, if we turn out to be wrong in the economics profession and the economy is actually not slowing down, well, then I will worry even more about inflation going up, and therefore that the Fed should therefore really begin to think more about rate hikes and worrying about inflation being sticky and not coming down as significantly as they have currently in their long-term forecast.
So let's just look real short term then. Do you think that the Fed, I guess it's a two-part question, will cut rates in late October, and do you think they should cut rates in late October?
I think they will cut rates, but I think we're getting to the point where we need to look very carefully at the inflation outlook. I understand, of course, service sector inflation for a long time was going down, but in the last 3 months, it's actually started to move sideways at around 4%. Goods inflation, that has certainly started to move higher, partly because of tariffs, partly because of the dollar going down. So when we put together our Apollo forecast for inflation, goods inflation is certainly moving higher. Partly because of tariffs, because inflation is measured year over year. That means that year over year, inflation will be rising. Service sector inflation, in what we just saw that came out here a few minutes ago, you are beginning to see more upward pressure on ISM services prices paid, which is also telling you that maybe there's a risk even to the upside also for services inflation. So that means that both goods inflation is at risk of rising, and now we're seeing here at 10 a.m. a few minutes ago that service sector inflation is also rising. That brings me to the conclusion that maybe in October, it would be a good time to pause and have a careful look at what are the alternative indicators for inflation telling us at the moment.
Well, and Torsten, let me ask you this as well. As you know, consumer spending has been incredibly resilient this year, even with all of the, sort of headlines and headline risk. What have we seen in the, if inflation is going to be persistent, does that feed back through and depress consumer spending?
Yeah, because the real challenge, of course, is that if inflation starts to stay higher for longer, that is not only the Apollo forecast, that is also the consensus forecast, that is actually also the Fed's own forecast. It has exactly two consequences. Number one is indeed that then, of course, consumers will find prices higher. That will have impacts, of course, on real spending, meaning how much people will be buying. Walmart said this through this earnings season. Well, meaning with the one we had in Q2, we are going to raise prices. And at the same time, of course, we should expect that we're going to see lower sales. So a very important first conclusion is that this will indeed impact consumers, especially more price-sensitive consumers. The other added effect, of course, is that if inflation is higher for longer, that interest rates will also stay higher for longer. And that means that it will still continue to be more expensive to borrow on your credit card, more expensive to borrow on your auto loan. And as a result, we have already seen delinquency rates rise since the Fed began to raise interest rates in 2022. So we are already seeing people falling behind on credit card payments. We're already seeing people fall behind on auto loan payments. And if inflation now is higher for longer, it's just going to take longer before we begin to see some improvement in the delinquency rates across different types of consumer credit. So the short answer to your question is consumers are hit partly by higher prices, which is the direct impact, but also by the indirect effect that the Fed will have to raise interest or keep interest rates at higher levels for longer to make sure that inflation does come down to the 2% that they have been mandated to hit by Congress.
As we know, Torsten, there's been an offsetting effect in the market from all of these sort of economic cross currents, and that's AI, which has sort of like swept away everything else. You've written a lot about AI, its contribution to GDP, but also market concentration in AI companies. And it's just getting more concentrated. The market's going, yes, there's been a little broadening, but it's still very concentrated here. So what most concerns you about the AI cycle at this point?
Yeah, Julie, and I know you have covered this so extremely well because this continues to be a very important backdrop for the macroeconomic conversation, namely, what does it mean for investing? And when we think about the macroeconomic backdrop, all of us, of course, we immediately begin to say, well, if the economy is accelerating or decelerating, how should I think about the outlook for the S&P 500? But what is absolutely critical in between that discussion is exactly this issue that essentially the AI story now makes up 35% of the S&P 500. The 10 biggest stocks make up almost 40% of the overall S&P. At the same time, earnings have been highly concentrated in the Magnificent Seven. You also have had CapEx spending, including data center spending, has been very concentrated among the Magnificent Seven. You also have returns across the board. The S&P 500 is simply no longer the diversified investment that it used to be because the AI story is so pronounced. And with some of the recent developments, including in the census bi-weekly survey of more than 1 million US companies and asking them, what is your adoption rate? Have you over the last 2 weeks adopted AI? You're beginning to see to this question where companies are asked, have you adopted large language models? Have you adopted voice transcription? Have you adopted readings of documents? And those different types of questions, in particular, larger companies are now beginning to say, you know what? Our adoption rate of AI has begun to slow down. So the real risk to the economic outlook is if the AI story starts to fade, if it is a worry here, which it is for many, including me, that maybe a lot of AI companies are indeed overvalued, then it would begin to have some significant risk when we think about the S&P 500. That is different from the S&P 493, but it certainly means that there's a very, very high concentration in the AI story that's driving the stock market forward, which, to your point, is exactly somewhat disconnected from what's going on in the economic outlook.
Torsten, we'll keep watching to see how that AI story plays out. Great to catch up with you. Thanks so much.
Thank you.
Are investors flying blind? And could AI hype be turning into an AI bubble? Keith Lerner, Truist Chief Investment Officer and Chief Market Strategist, joining us now. Keith, it is great to see you as always. So obviously, Keith, we've been talking a lot about this government shutdown. Investors, Keith, have not seemed all too concerned about it. I'm interested why you think that is. What explains that reaction? Is there any kind of risk there, Keith? Any risk that we're being too complacent about all this?
Yeah, well, Josh, great to be with you on this Friday, and you're asking the right questions. I mean, I think the first thing is a lot of people are aware by now that when you look back at these historical shutdowns, and we've had 20 of them going back to the 1970s, the average market performance is basically flat. So I think, that's one thing that the historical guide. And then also, if we think about all the shift in narratives that the market has had this year, from inflation to tariffs to interest rates, the markets has become somewhat numb to the news flow as a whole. Again, and so then that leads to your second question is, hey, is there some complacency? Maybe on a short-term basis, but I do think that if I zoom out a little bit and I think about 3 months from now, 6 months next year, is this going to be the main story? Probably not. The main story, the North Star of this bull market, are profits. Profit trends continue to move higher. And I think really what's going to be most important for investors is this upcoming earnings season, which actually takes off in less than 2 weeks from now.
Keith, we didn't get that jobs report, of course, though, today. Does that give you any pause that, you don't have line of sight like maybe you normally would?
On the margin, it does complicate things, especially when there's this healthy tension between concerns about inflation and employment. But let's also recognize that the jobs picture, as much as it's the gold standard, we just had a revision of 900,000 jobs. So I think in the interim, the market is going to continue to look at private data. So we had the ADP report, which was somewhat slow. We did just get the JOLTS report right before this shutdown, which also showed some softening. And what you're seeing in the Fed funds market as a result of that is the market starting to price in 2 rate cuts by the end of the year. So I think the question also is the next Fed meeting isn't until the end of October. So the longest shutdown we had was about 34 days. That was the last one in 2018. So if we get closer to that and we don't get, the Fed doesn't have the reports, I think that may become a little bit more problematic. But I really do think that going back, more of the forward-looking guidance from corporations in a few weeks is going to be the most important, especially given where valuations are today.
Yeah, well, I wanted to touch on that, Keith, because you mentioned how profits are solid. But how would you characterize valuations, Keith? Because listen, you won't be surprised to learn. I don't hear strategists coming on the show, Keith, and telling me, hey, we look cheap at these levels.
Yeah, listen, I mean, to be fair, by any historical metric, we are somewhat rich. Now, we can say there are reasons for that. I mean, one example is if you think about technology and what I call technology plus, it's almost 50% of the market. Back in 1990, the technology sector was about 5% of the overall market. So the other thing that I think has happened the last 4 or 5 years is, our companies have been battle tested. As I mentioned, we had the fastest rate hiking cycle since the 80s. We had the highest inflation since the 70s. We had these supply side disruptions. And what have we seen? We've seen companies resilient, adapt, and I think the market is rewarding that as well. So yes, valuations are high. That typically has more of an impact on long-term returns. On a short-term basis, as we all know, it's hard to make a big market call just on valuations. And that's why I say, profit trends, which have been moving higher, which are also at an all-time high, has been the North Star. And that's why even though valuations are rich, we're still constructive, even though we do realize expectations are somewhat, elevated.
What do you make, Keith, as an investor, as a strategist, about this talk bubbling up of an AI bubble? There was this headline from Axios, I don't know if you saw this one, Keith, the biggest sign of an AI bubble is starting to appear, and they were really, in this piece, kind of talking about all the debt used for funding this AI boom. But what do you make of that, this talk of an AI bubble?
Well, we don't think we're in an AI bubble, but I think some of these things do show we're moving to another phase, and that kind of debt finance and some of the circular things that we've seen with Oracle and OpenAI, it does raise an eyebrow. But if we quantitatively look at the technology sector and compare it to the bubble where I started my career, I started my career in 1997. I lived through that bubble. When you look at a year-over-year basis for technology, we're up about 28%. So that's strong, but historically, even over the last 20 or 30 years, the red alert has been when we're up 75%, 100%. So we're not there. And then the other thing that we looked at is the kind of relative earnings trends of tech relative to the market. That's making new highs. That's different than what we saw in the late 90s, where there was a lot of companies that weren't profitable as well. So I definitely think there's some pockets of things that are bubblicious, but as a whole, we're still seeing the strongest earnings in tech. And again, going back on that year-over-year price appreciation, it's not really comparable to what we saw before.
So you're saying, Keith, bottom line, the stock market here, we're higher at year end than we are now. What could derail that, Keith? What would be on your wall of worries?
Yeah. So just one question, going back to the why we think the market likely moves higher, even if you see at least one more hiccup before year end. When you head into the fourth quarter after you've had strong momentum, so more than 25 new highs, the final quarter is up on average about 5%, and it's been up about 89%. So you have history as a starting point on your side. To your question of what would derail that, well, I think the main thing is going back to my main point. If profits are the North Star and they've continued to outperform, if we see moderation in that will be the concern. And we have to remember, last quarter, we had a blowout earnings season relative to expectations. Now, as we kind of move through a little bit later on the tariff flow and the consumer, we'll get a better read into this next earnings season. So I think that's the key. Of course, something can come from left field. That's hard to predict. So we're really focused, really on the main driver to us is profits.
Keith, always good to see and to have you on the show. Have a great weekend.
You too. Thanks so much, Josh.
Always great to see you. So here's what you're telling clients, Sam. You put it like this. You say, history reminds us that government shutdowns have typically been more headline making than bottom line impacting. Walk us through that, Sam. What do you mean by that?
Sure, Josh. Good to talk to you again. Well, what it really means is that the market, might sort of hold its breath during the first couple of days of a government shutdown. But let's face it, in the typically average 8-day shutdown, the market has actually risen in that time period and has posted a positive batting average, meaning it's gained more days than it's lost. And if you go back to 1984, because we had been seeing shutdowns for about 10 years prior, investors started to say, okay, tell me something I don't know. And from that point forward, the market was up more than 70% of the time during the shutdown, and then was higher more than 90% of the time in the 30 days after the shutdown. So basically, shutdowns have been non-events for the market, but they've been great things to talk about in the financial media.
Let me ask you something. There are economists who suggest, and I want to run this by you, they'll say, well, what if this shutdown lasts longer than we expect? What if it lasts longer than just even a few weeks, and then the Fed doesn't have that hard data they want and expect, and maybe the Fed then, maybe they don't cut at that next meeting, Sam? One, what do you just make of that hypothetical? And two, if that happens, Sam, how would you expect the markets to respond, to react?
Well, first off, back in 2018, 2019, we had a 35-day government shutdown. And in that 35-day period, the market was up 10.5%. And then it was up another 5% 30 days later. So if you really were going to be saying, well, gee, if this ends up being a drawn-out affair, well, let's go right back to 2018, again, under a Trump administration, and the market did just fine. So, I would tend to say that history would refute the worries that investors have at this point. I also think that because the Fed cut at the most recent meeting in mid-September, and because the data had been looking soft, I think the Fed would err on the side of caution by cutting again in October and then say, the government should be reopened by the time we have our December FOMC meeting. So if the data looks a little hotter than we thought, well, then maybe we'll hold off on another cut in December. But I think essentially investors are focusing on the 4 E's. Enthusiasm surrounding AI, the expectations for at least one more cut by the Fed this year, emotions. We can see it in the term of FOMO, or fear of missing out. And then lastly, earnings outlook for Q3, which right now is expected to show a 7% gain.
I was going to get to that, Sam, because listen, that earnings season is going to be here before you know it. What are your earnings expectations, Sam? What do you want to see and hear from those CEOs and CFOs?
Well, everybody wants to hear good expectations. And I think management has always done a very good job of managing expectations, because we have seen 64 of the last 66 quarters post actual results that exceeded end of quarter estimates. Right now, the expectation is for about a 7% year-on-year gain in Q3 for the S&P 500. We're looking for 6 of the 11 sectors to post advances. The biggest gain is likely to be technology, with a 21% year-on-year rise, and then followed by strength in industrials, and also looking at good results for the communication services category. So financials as well should post strong earnings. So I would tend to say that even though the bar is a little bit higher than where it was when we started reporting the Q2 earnings, that there's a good likelihood that this quarter will see beats as well.
What about overall valuation, Sam? I realize, listen, it's not a market timing tool, but even Jay Powell sort of suggesting we're stretched here at these levels.
Well, you could say that, is that 2000, gosh, it's so long ago, 1996 all over again, when Alan Greenspan talked about irrational exuberance. So maybe we are early in the game, but you're absolutely right. If you look at a 20-year history for the S&P 500 valuations, we are trading at a 42% premium and a 63% premium for the technology sector. If you look to a 5-year average, however, which some tech analysts are talking about because that's really as long as AI has been around moving the market, we're still looking at a 16% premium for the S&P and then an 18% premium for technology. So I would tend to say, yes, valuations are elevated, but I think that the momentum is such that this market will carry forward to new highs as we proceed in the next couple of months. And then I would say worry about digestion early in 2026.
I want to end here, Sam, just bottom line. On a sector level, walk me through it where you see opportunity. Where do I want to be overweight?
I think you want to be focusing on the momentum areas still because we have 3 months to go. And I think a lot of professionals are behind their benchmarks. And so they want to not only earn their bonuses, but also keep their jobs. So I would say technology, certainly, because they're expected to post a higher earnings increase for this quarter, communication services, and financials. And then to a lesser extent, looking at the industrials, where we've seen today a little bit of a pop in those also rans, meaning energy, healthcare, staples, but I still think it's the momentum play that will carry us through.
Sam, always great to see you. Enjoy that weekend.
Thanks. You too, Josh.
So listen, we talk a lot on the show about AI. It's already impacting sectors, markets, different industries. You obviously think it could really impact investing. Talk a bit about your app and how it works, George.
So I come from the institutional world, and I worked at my first hedge fund when I was 17, and even on the buy side, I felt pretty disadvantaged versus the larger guys. So I've worked in AI for 15 years now, and what I've really been focused on are like underlying market equations. And so a lot of what we do is just visualize what institutions are doing in real time, make it simplified for retail investors, and try to help anyone pick stocks like a pro. And not only do we have that, we have newsletters that basically teach portfolio management around the 10 signals that we've built. And what we like to say is we can explain a stock completely with those 10 signals without really overwhelming people.
How does the AI, George, in simple terms, how does it actually work though? How's it picking stocks? Is it technicals, sentiment, fundamentals? Walk me through it.
All of the above,
Yeah.
right? A lot of what we use AI for is organizing information and adjusting in real time. So we have foundational algorithms that will take something like net option sentiment, which is summarizing the short-term options markets, and we'll do things to intelligently tag what we call robotic signatures. So kind of like the opposite of an option sweep order. We're looking for methodical movements across many different strikes, across many different expirations. And then we're looking for a lot of behavior in volume, in open interest. And then we actually ask the AI, based on market conditions, to figure out how to weigh that stock and represent that signal on a given day. And that's all up to the AI and what it's learned based on the relationship between the market and the signals going back and then forward.
There are other AI trading platforms, George. What kind of makes you all different? What's the competitive advantage? Is it the algorithm? Is it the data sources?
So I think the primary thing that really makes us different is we're actually focused on intelligence that helps anyone have better outcomes. You know, a lot of these things are either building portfolios in an automated way or picking stocks. And, you know, I use all the same tools that everybody else. And if you ask like an LLM or if you ask GPT to rank stocks, what they'll often do is they'll give you the biggest upside stocks and they won't understand risk. And so what we're really trying to do is we're trying to filter down the information, take the best of AI in terms of how to interpret the information, elevate certain stocks based on those signals, and then teach people how to manage portfolios with those signals. Because what a lot of people will tell you, even at the best hedge funds, is that people are still using data to make better decisions than fully automated systems. So we are trying to empower retail investors in a very similar way.
And what's the app's performance like, George? Is it consistently outperforming the broad gauge?
I mean, what we do is we give people signals in the app, but you can go on Republic, we're running a crowd fund right now, and see the reviews. People using the signals have gotten great results. We've seen people, multiply their traders multiplying their results on a higher level by like 50%. We've seen people find 300, 400% gainers that they wouldn't have had otherwise. But to show people how to use it, we've been making newsletter picks that we give away for free for the last 4 years. Those picks have been beating the S&P by an average of 67%. It's a paper trading portfolio, but it's still very powerful. And we've done things like got into Meta at 170, we got into AppLovin at 112, we got into ASTS, I think for the first time when it was at 15. Mm-hmm. This is the AI showing signals that are elevating the stocks that tell us, wow, this has big potential based on especially where we see institutions betting in size in the options market.
So I got to ask you, what are the picks now?
The picks now, right now, some nuclear names, LEU and UUU I'd say those are the strongest in the signals in terms of what we see as potential. We also really like Baidu. Alibaba, some of those Chinese stocks have been doing very, very well in our metrics recently. And we just added INOD. That just recently came up, big momentum in our system. And then if you kind of pull back, we love the qualitative story. They've got a unique position in the AI space. They're growing really, really fast. And what we do is what we tell our users to do, which is a lot of the times the signals flag these. And they flag them in, whether it be options momentum, sometimes it's, thesis built around, where analysts are trading, combined with, we're raising their estimates around those things. And it just kind of, we use these signals. Sometimes it's social sentiment, sometimes it's elevation in the dark pool. Those are just 10 of our different ones. And then we say, hey, I can see why this makes sense. And that's how we come to the names. That's how we have a lot of our biggest gainers. But a lot of the times it's like the signals, screaming that these are great opportunities, and we're just checking them.
George, great to see you, especially on set. Thanks for your time.
Thank you.
Well, the AI trade continues to power markets higher. Semiconductor stocks added billions in value after OpenAI's latest share sale pushed its total valuation to $500 billion. But my next guest warning of some risks to the rally. Joining us now is Michael Aroney, State Street Investment Management Chief Investment Strategist of the U.S. SPDR business. So, Michael, thank you for being here. Look, we have tech stocks powering higher once again, that OpenAI valuation news. What's your reaction to that and where we stand in this rally? Is there still more room to run looking out to the end of the year?
I do think there's still more room to run, Allie. I think the foundation for this bull market remains solid. I think trade is getting a bit clearer. I know it may not always seem like that, but now we're adding both stimulus, both from the One Big Beautiful Bill Act and monetary policy stimulus. And oh, by the way, earnings are growing by double digits and profit margins remain high. And the U.S. has never entered a recession when earnings growth has been rising year over year. So there's a lot to be happy about. The AI spending, a big tax refund next season. Of course, the U.S. is hosting the World Cup. So all this is fueling the optimism and the bullishness from my perspective. So I do think this rally has legs, but of course, there are some risks.
And let's talk about some of those risks. What do you think are the biggest risks to this rally? And you also said that even though valuations this high can continue, markets may be due for a correction, even if we don't see one.
So, Allie, I think the discomfort that I have is that the market's up more than 30% since the April lows. And the max drawdown, the kind of worst from high to low period that we've had, has been less than 3% over that time. And that happened way back in May. So we know trees just don't grow all the way to the sky. There has to be some healthy pullbacks in order for the rally to continue. And we just haven't had many. Even today, European stocks are hitting all-time highs. South Korea hit all-time highs. So it's not just a U.S. phenomenon. So the risk appetite has been very, very strong. So valuations are stretched, prices are high. So I think some of the risks include trade policy could be an impact. Certainly earnings disappointment. Third quarter earnings will start to get released in a couple of weeks and the bar has been raised. So I think this poses some potential risks of disappointment. What happens if those AI hyperscalers and other companies don't meet what's been growing expectations? And then finally, I think the Fed finds itself in a difficult position where inflation remains above target, yet questions are kind of arising about the economy and the labor market. What happens if they're cutting too aggressively at a time when inflation remains stubbornly high? To me, those are the three most identifiable risks to this rally.
And I have to ask this question, and I feel like a broken record, but it is the number one question on investors' minds right now, bubble risks. You were talking about some of those stretched valuations. Are you at all concerned that there's too much frothiness entering the fourth quarter?
Overall, I don't think we're in any type of bubble territory. This isn't the technology, media, telecom bubble of the early 2000s. These companies are incredibly profitable. When I look at the S&P 500 in aggregate, and of course, this is influenced dramatically by the Mag 7 in the tech sector. Companies have a return on equity of north of 20%, free cash flow margins north of 10%, and they return more than 70 cents of every dollar earned through either dividends or net buybacks. These are incredibly profitable companies with healthy balance sheets that are generating a tremendous amount of free cash flow. That's a big departure from bubble-like conditions that existed earlier this century. So as long as that continues, I'm not sure we're in bubble territory. These companies demand a premium. The question is how big or how much should that premium be?
So how can investors play that, be exposed to AI without being too far into some of those more frothier corners? And I know you expressed a barbell strategy of sorts. So what does that look like in practice?
So from my perspective, given our bullishness about the potential for this bull market to continue, but some of the risks we've identified, having a barbell strategy in your portfolio makes some sense. So on one side, given our enthusiasm for earnings growth and the AI phenomenon, we would suggest continuing to be overweight areas of technology, communication services, financials, where they're highly profitable, earnings are growing, and they have a kind of an attractive outlook from that perspective. But in order to offset some of those risks, we think there is a potential for both interest rates and inflation to remain a bit more volatile and higher than the market expects. And so that proves problematic for those bond portfolio allocations. So we think having a diversified portfolio of real assets, infrastructure, real estate, commodities, natural resources, and precious metals, including gold, help to manage or offset some of those risks. So that's the second part of that barbell, Allie.
And Nancy, great day to have you on. I know you've been very constructive on this trade, but just your reaction to see the sheer momentum that we've had since those lows back in April and your outlook for the rest of the year.
Yeah, thanks so much for having me, Allie. I think what investors can learn from this experience is you have to actually jump in when it feels the most painful. We were adding to a number of the chip names in April. We were adding to Tesla. It wasn't easy to do, but if you believe that the technology is real, and we believe it is, then you use volatility as your friend, as a long-term investor. So I'm surprised, but not surprised. I think we're due for a bit of a pullback. We may not get one, but we usually get a correction about once every 12 months. We had one obviously in April, but we've run pretty hard and pretty fast. That said, it's driven by earnings. I mean, this is not a speculative bubble as we saw at the end of the 1990s. And I've drawn the analogy to the 90s for almost 4 years now in a positive way. This technology, however, is much more robust than the internet was and eyeballs on a screen, which was how we were valuing companies back then. So I'm pretty excited. We still like many of the names, and we hold almost all of the names, I think all the names you had up on the screen.
So volatility is your friend. It seems like you would advocate to buy any dips, but since we haven't seen a ton of dips so far, how do you play this space and find the most attractive opportunities when a lot of names are really at these record all-time highs?
Yeah, so we've been broadening out. We just launched a strategy that is a macro cycle opportunity strategy. So think quantum, space, robotics, AI, and nuclear, the leading technologies that will take us through this industrial revolution. But remember, these changes, these transformative periods can go on for a long time. And historically, the market has been concentrated in the names that are driving the technology. So if you own them, you want to hold them. If you get a dip, and we do. I mean, we were buying NVIDIA at $108 a share back in March and April. We bought Tesla at $240 a share. You will get pullbacks, and that's when you step in if you don't own them, or if you do own them to add to it. They will not, I mean, the market doesn't go up in a straight line forever. So we will see some sort of a pullback, and that's when you really want to just get in there and add to some of these names.
So what are those specific picks for you, Nancy, outside of some of those mega cap tech players that you were just referencing?
Yeah, so we have a few for you today, Allie. I mean, we've talked about on your air for a long time Broadcom as the poor man's NVIDIA. We still like it. It's one of the largest holdings in our ETF TGLR. We'd still own NVIDIA, love it. But one of the names we've held for quite some time and we think has a ways to run is Lam Research. So think global supplier of wafer fab equipment. They are dependent on memory, which had slowed, and now the cycle is beginning to pick up. Not just in memory, but NAND in particular. So Cycle is beginning, and they grab about 2/3 of the NAND market. TSMC is one of their largest clients. Stock's up 100% or so this year, 102%. But you're getting paid a dividend that's yielding about 7.7%, but growing at 15% annualized over the last 5 years. So you are getting paid to wait for the company to continue to perform. That's one of the names in chips that I don't hear a lot of people talking about. Another name in our new strategy is Symbotic. They are a robotics company that has really developed the back office of Walmart. Now, the downside is Walmart is 85% of their revenues, but the upside is they've been expanding their client base, and the CEO put in 800 or 700 million of his own money. So, and one of the important things I think to note about all of this is we've talked about Walmart as the poster child for old economy companies pivoting. The first customer to buy Symbotic software was Target, and then they decided not to go through with it. Walmart did, and you can see the difference in the stock price performance.
You've also flagged Spotify as a top pick, and we did get some news this week that they are going to be shifting to a dual CEO structure, similar to what we see with Netflix. Daniel Ek will be moving into that executive chairman role. What makes you so bullish on Spotify, and what's your reaction to that leadership shakeup as well?
So I think the leadership shakeup, Allie, was pretty well known. I mean, the two gentlemen, Soderstrom and Nordstrom, became co-presidents a couple of years back. This has been telegraphed. Eck is saying he's going to stay actively involved and be a European-style executive chairman, but they have room from a pricing standpoint to continue to grow. Monthly average users is expanding. It has run hard, and we have trimmed back our holdings, but it is still a member of our 12 best ideas portfolio, and we just continue to like it. I mean, if the economy slows, this is a company that continues to drive growth because it's kind of the last thing people cut, like Netflix in their budget. So we do still like the company. I wouldn't chase it here. I'd again wait, but we're holding on, and as I mentioned, it's in our 12 best ideas portfolio.
So how do you know when to trim back when stocks have run hard? Because again, we're in this environment where we just keep seeing higher highs.
Yeah, no. So if you're a retail investor, you don't necessarily need to do what I do because every sale has been a bad idea or trim because in a bull market. And so, but as a portfolio manager for institutions and large families, we have a commitment to not let the market make our asset allocation decisions. So, think Apple, we acquired it in 2013. If we had not trimmed it back, it would have been 15-20% of our portfolio at one point. So in the interest of diversification, we do trim back, but we run very concentrated portfolios, Allie. We have the 12 best, and then in our large cap strategies, it's max 30 names. So we do the research, and we make our decisions and overweight decisions based on the fundamentals and valuation to some extent. But it's the same with a name like Tesla. We have trimmed it when it got to current levels, but then we've bought it back. Generally, though, our core position has remained constant.
And there's been a lot of buzz around private markets after that $500 billion OpenAI valuation. Is private AI exposure something you've ever considered, or would you prefer to stick with those public names that have a bit more liquidity and you more disclosure as well?
Well, shout out to EquityZen. They've got a great model where you can go into their fund and they own actual shares in these private companies that, and the liquidity is it provides liquidity for some of the insiders, which is a pretty cool concept. Think if you're in a company that takes 10 years to go public, it's great if your valuation, the stock valuation has quadrupled, but if you can't realize any of that benefit, it's not so good. So it's a win-win for the insiders and a win-win for private investors. We are in the process of starting our own fund through EquityZen in order to be able to offer those shares to our clients. And the names I'm excited about are XAI and SpaceX, and of course OpenAI. But it's a new area, and I think it's matured enough that retail investors can get in.
Yeah, exciting time for a lot of investors right now. Nancy, thank you so much. Appreciate your insights as always.
One stock you buy and keep for a year.
That's going to be Nike. I front run myself.
Okay, I like that. The Fed cuts. You think they will be too soon cutting rates or too late?
I think they're fine. I think that Jay Powell's doing a great job. I don't know how he does it with cartoons written, "You're fired." Jay is an amazing guy, and I met Jay years and years and years ago, just at a party, and I said, "This guy is like really smart." And everyone else was saying like, "Yeah, but like he's like smart right now. Can't we just have a little fun?"
Mm-hmm. Recession next year or no?
No, are you kidding me? I'm not worried about a boom over here.
Most underrated CEO in the U.S.
Kelly Ortberg, who's turning around
Boeing.
Yes.
You think he can do it? What does the turnaround for Boeing look like?
It means living like you did on the floor, hit the street. He's living on the factory floor. By the way, humorless. I love that.
If you weren't doing Mad Money, what would you be doing?
I was doing Mad Money at home. That's the problem. I'd be just like looking at hey, I think you can buy.
Gardening, you like to garden?
I do like to garden.
I have seen these giant tomato photos of you.
No, I had a good garden this year, but my wife had to do all the sauce because I had to read my book by audio, and it was I lost a couple Saturdays, so we only did about 40 jars. I'm gonna have one tonight though.
Biggest investing mistake you've ever made in one word? Or two?
No, I'm thinking I'm gonna say Memorex, and here's why. It was a $2 stock. And I kept buying it at 1 5/8, 1/2. I said, how much could you lose? And I lost everything.
Last one, I'm just adding in here and then we'll let you go. NVIDIA, what does the next 10 years look like for one of the companies that you helped discover?
Okay, NVIDIA is going to make I don't want to threaten anybody or scare anybody, okay? But the next iteration, which is the Vera Rubin, who is from Philadelphia, is a reasoning chip, reasoning platform. So you could ask it right now, if you're a fourth-year associate at a law firm, you can help look things up. Someone would say, I need the history, I need everything that's ever been, every judgment that we've ever had on this one issue. The next one is going to be, let me tell you what I think, and it's going to be maybe superior to how you're thinking.
Wow.
So you don't need that fourth-year associate anymore. That's the big breakout, is the reasoning one. And we're all going to struggle with whether it reasons in a way that's better than ours. And there'll be far fewer mistakes. They do have to start getting deals. Like they have to start doing deals with the New York Times. You ever see you never get the Times because the Times is trying to stop them. That's why Cloudflare is such a good stock. But that is the next NVIDIA, Jensen tells me, is the one that is going to dazzle. Do you know what read Moby Dick in a second?
Really?
Yeah.
That's not
actually, it was Grace Blackwell read it in a second.
That is.
And Moby Dick's a hard book to get through.
Yeah, I remember reading as a kid, Jim.
Call me Brian.
Okay. Really good. Jim's got a lot to do.
Can I just say one last thing?
Please, go ahead.
I think you're that.
You're the man. I could actually, if you actually had time, I mean, this is like a 3-hour thing, but I know this is not Joe Rogan type podcast time. Jim's got to go. He's got shows to host. He's got people to do. He's got subscribers, and he's got a life to live. Get Jim's book, his 8th book, How to Make Money in Any Market. Jim, thank you for everything
Brian,
you've done for me.
So much.
No, I'm serious. Really.
Oh, thank you for everything you've done for me.
You're the man.
So, shutdown. What are we thinking about the shutdown? Because as we've been saying, usually the market does okay through a shutdown. This morning things are down. It seems like this shutdown is causing a little, there are always jitters at the beginning, but this one seems a little unique also.
Yeah, listen, you can't ignore the market backdrop, right? As Ines and you covered just before, look, the markets are at pretty much all-time highs. Tension is high. We have earnings just around the corner. So, it's not so bad that the market is sort of reacting this way. But, historically, again, if we look at these shutdowns, looking at the last 10 of them, markets tend to fare pretty well, even if they last longer. Now, of course, the last one, which was the longest, that had some interesting events around it, right? You had the market already tanking. You had the Fed raising rates.
This was in December of 2018.
2018.
Right.
You had already the Fed raising rates and then last minute shifting. So that kind of affected how the market reacted. But ultimately, even if you look 6 months out after all of these have ended, we see generally positive results. So you can't ignore that. But there are some differences here too, like the furloughs and things like that.
Right, if they end up making the furloughs firings,
Yeah.
Does that change the equation? Is that enough? I mean, we already have concerns about the job market. ADP this morning was pretty lousy.
Yeah. Well, it definitely will have impacts on the economic numbers. Whether it phases the market, that's a whole other question.
Yeah.
I think we got a lot of shock and awe earlier this year with Doge and layoffs and things like that. So the market may be a little bit sort of hardened to that reality. But these numbers, you cannot ignore these numbers. And we have to see how they're going to play out and how the Fed is going to respond respond to that. I mean, clearly the markets are now factoring in more aggressive Fed rate cutting. That should put some downward pressure on yields. But government shutdown should put upward pressure on longer yields, right? Which a lot of people aren't talking about yet. I haven't seen that happen quite yet.
So we've been talking about what this all means for the Fed and the market for not having certain economic reports, right? We're not going to have the jobs report on Friday, likely. If this lasts longer, CPI is due for October 14th, I believe. But around mid-October, we also start to get earnings. So the market presumably will then just be taking its cues from that.
Correct. I mean, that'll be the ultimate arbiter, as it should be, right? We're gonna, we start with the financials, and the financials will hopefully tell an interesting story because they had some great beats last quarter. I think markets are starting to hope for the best, like the whisper numbers are a lot higher than the published numbers, but that could be the real telltale about how the rest of the earnings season goes. We have maybe 2 weeks before we start getting those numbers, and I think that's really gonna sort of set the pace.
Are you changing strategy at all right now? Is there any area where you're shifting sort of weighting in various sectors?
Yes. Well, we like the financials for all the reasons that you would like financials right now, and the yield curve and the expected moves in the yield curve, et cetera, the deal flow, all of that is there. But they are a little rich. And it's very hard to, sometimes you have to just pinch your nose and say, this makes sense. And it has worked. That strategy has worked. So we're always nosing around looking for opportunities in finance and financials. And there are some out there with maybe private credit and things like that. And of course, I hate to say the obvious, which is, technology still continues to play out. The deals that are happening this week are proof that there's something going on out there. There's proof of life. We're still looking for great growth in that, generally in that sector. On the low end, you're talking about 9-10% year-over-year growth in EPS. On the upper end, with things like NVIDIA, you're talking about north of 50%, right? So those numbers, they're slower than they were, but they're still fantastic, and you can't ignore the opportunity there.
Gotcha. So if there's any kind of pullback in the short term here, where are you going to be looking? Will you sort of double down on those things that had looked a little bit rich?
Yeah, I mean, listen, correct, yes, we're definitely buying our conviction areas, right? Those we're always looking for buying opportunities. Those remain tech, communications. We're looking at some of the financials that we like. But in terms of themes, there are going to be some themes that will probably emerge. Look, we would like to get more involved in consumer discretionary. That's a little challenging, especially given a government shutdown, which could possibly affect discretionary.
Well, why do you want to get more involved in consumer discretionary?
Because the potential growth opportunities over there, and of course, it's not across the board, right? You have to be very selective over there. But these are things that should play out in a growth-friendly environment, right? So we think this will be this might be a tougher quarter in terms of earnings, but later in the year and the first part of next year, that's when you're going to want to sort of be in those things, especially when you have in a Fed rate cutting regime right now.
Mark, good to see you. Thanks for
coming in. Great to see you as well.
Appreciate
Thank
it.
you.
So we head into the final trading day of the third quarter. Some of the top performing stocks include new entrants to the S&P 500 like AppLovin, media stocks Warner Brothers Discovery and Paramount Skydance, and tech plays like Western Digital, Seagate, and Intel, names that go far beyond the Magnificent Seven. Still with me for a deeper look at how stocks performed in the third quarter and what investors should now do. Kevin Mon, Hennian & Walsh CIO, is still with us. So, Kevin, we did see sort of some broadening in the third quarter, but most of the gains, and yes, on a percentage basis, you can look at the AppLovins of the world, but because of their size, it's still the likes of NVIDIA that are pulling things higher. Is that still the way to go?
And who would have thought we've been at this point, right? Year to date, the stock market's up over 14%. Remember, through the first 73 trading days of the year, the market was down 10.2%. But I have two reasons to still be optimistic over the balance of the year. One of them, believe it or not, relates to the Federal Reserve. According to data from Goldman Sachs, over the last 40 years, the Federal Reserve, when they have cut interest rates by 25 basis points following a pause of 6 months or more, as we just had, in half of those 8 instances, the economy moved into recession. That's not our base case. In the other half of those cases, when the economy continued to grow, even if it was at a smaller pace or a slower pace, the stock market grew by 8% over the next 6 months and 15% over the next 12 months. That's what I believe is going to be the case this time around.
So reason number one to be optimistic, the Fed cuts, and there is no recession.
Correct.
Okay, thing two.
Thing two, AI infrastructure spending. We continue to see billions upon billions of dollars of announcements in AI infrastructure investments. NVIDIA, their CEO Jensen Huang forecasted by the end of this decade, we could see 3 to 4 trillion with a T in AI infrastructure investments. As I understand it right now, we're around 600 billion. So if that is the case, where can we find pockets of growth opportunities, at least for the balance of 2025? Look to the AI infrastructure spending. That's where all the money is heading, and that's where you'll likely find the returns as well.
What about the concerns that sort of arose in the last few weeks, or reignited, because they're not new, about where that money is coming from to spend, right? Yes. Is it being borrowed in some cases? Is it NVIDIA investing in a company and then that company spending the money on NVIDIA, as we have seen some concerns about that? And then the other side of that is, okay, there's all of this push to spend.
Yeah.
Where's the return on all of that investment?
So it's a great question. And I continue to use the example that we're in batting practice of a doubleheader as it relates to the AI revolution. Batting practice is the AI infrastructure build out. The games will ultimately involve the implementation of these AI algorithms that will transform the economy and society and likely lead to returns on investment. But that's years down the road. So where are the opportunities right now? Look in the industrial sector. I know it doesn't make sense that you'd look for an AI play in the industrial sector, one of the top 3 performing sectors year to date, but you look for companies such as IES Holdings. They do the electrical connectivity for data centers. Or a company like Comfort Systems, who supplies the cooling solutions to data centers. Or EMCOR, which was just recently added to the S&P 500. They do the site design and construction of the data centers. All part of the AI revolution, but not in the technology sector. And they're receiving returns on their investment right now because they're flush with money that's coming in from large cap tech to build out these capabilities.
Okay, so you've given us 2 reasons to be optimistic,
yes.
A bunch of investment ideas. What about the other side of all of this? What are you worried about?
I guess I'm most worried at this point in time about the uncertainties. The uncertainties ultimately about what the new tariff and trade framework will look like. Uncertainties over what the Federal Reserve will or won't do next. I remain concerned if this shutdown does last longer than all of us anticipate right now, and it limits the Fed's ability to be more transparent and have some clarity around jobs data and inflation data, and they pause in October. I still believe they should have cut for the first time back in June, but they didn't call me, they didn't ask for my opinion. So if they
You're not on that list.
No,
of
I'm not on that list for some
federal,
reason.
Yeah.
Jay, give me a call. But if they pause again in October because they don't have data, is that going to then seep into the economy? According to the Atlanta GDP right now, we're looking at about 3.9%. For Q3, with 3.4% coming from the consumer. So that seems good, that seems vital, that seems healthy right now. But if that's all the Fed has and they don't have anything else, they're going to say, well, maybe we need to pause here.
Right.
And I think that could really derail us.
And you're not worried about the job market, it sounds like, or the job market weakening and that feeding over into spending.
I am, and I think the Fed is more concerned about that as well. I think they're more attentive now to the job side of their mandate than they are to the price stability or inflation side of their mandate. I also don't believe they were factoring into their calculus 911,000 fewer jobs being created over the last 12 months. That's why we saw that 25 basis point cut, and that's why I believe we're likely to see 2 more rate cuts, according to their own dot plot chart, over the balance of this year, provided that they have jobs data to look at.
Yeah, and if the shutdown goes on and some of those furloughs turn into firings, then that number could go up more. The other thing I would ask you about is, even as you are positive and optimistic, are you still recommending clients or holding in portfolios gold, things like gold? Are you sort of hedging at all?
I wouldn't look at gold as an inflation hedge, because if you take out the decade of the 1970s, it's actually one of the poorer performing asset classes as it relates to hedging against inflation. But I am recommending them to diversify even further. Look to international markets right now. They're actually outperforming US markets year to date.
Right.
And surprisingly enough, emerging markets are outperforming developed markets. Consider adding some value or some dividend plays into your portfolio. We've gone too long now without any realistic or significant short-term bouts of volatility. We shouldn't expect that to last for that much longer. But I do believe with each short-term bout of volatility, that will be greeted by cash coming off the sidelines, because investors will look at that as an attractive entry point. So expect more volatility, but also anticipate those periods of volatility being short-lasting and create even more opportunities for investors.
Kevin, great to see you. Thanks
You
for
as
coming
well,
in.
Jill. Thank you.
Appreciate it.
Kathy, thank you for being here. Let's start with what the bond market is telling us. I mean, we've seen yields go sharply lower as investors continue to price in expected Fed easing. But now with the ongoing government shutdown, the still unknowns when it comes to inflation in the labor market, what should we glean with what's potentially to come?
Well, it's a real problem without the government data. We have private sector data that's giving us some information, but it's not at the level that the government data is. So we're a little bit in the dark, flying blind here, as is the Fed. I think, though, the longer the shutdown goes on, the less economic activity there is, the greater the risk is that we have a downturn in the economy, or at least a much softer economy in the fourth quarter. And that could lead the Fed to cut twice rather than the one time that we expect. But it's really fluid right now because you have conflicting signals. The Fed's dual mandate is in tension. Inflation's too high and edging higher, and growth is in the labor market is slowing and looks like it's getting worse. So that's in tension. And without information to inform us as to how the economy is going, we're kind of left here in the dark. And I think the bond market's kind of reflecting that. It's just sitting in waiting in a narrow range, waiting for something to happen.
You mentioned that we do have access to that private sector data. What data points are you looking at? What data points is the Fed looking at, given the fact that we're in the dark when it comes to that government official data?
Yeah, I was looking at this ISM data. We looked at the ADP employment data yesterday, consumer confidence. And I think what it continues to tell us is we have an economy that's running on two tracks with, wealthier people with higher incomes doing fine and continuing to spend. And in aggregate, that's keeping the economy growing, like consumption. On the other hand, you have a lot of softness in the labor market, particularly for younger workers or for people who traditionally have had a harder time finding employment. So you've got two different tracks going here. And the consumption level is holding up GDP growth, but the weakness in the labor market could lead to, a significant downturn the longer this goes on. And not the least of which is if the administration succeeds in firing a bunch of federal workers, that's going to send the labor market into even more of a downturn. So Fed has to watch these numbers. They take a number of surveys. Every Federal Reserve Bank has surveys monthly in their district. They're going to pay a lot of attention to those numbers because that's data that they can gather and that's their constituents. So we're just going to keep an eye on this. My bet is that they do cut rates another time in the fourth quarter, maybe twice. But that inflation data, inflation pressure just doesn't look like it's going to ebb anytime soon.
Yeah, and I've been having that conversation with a lot of folks out there that inflation, it's really not going in the right direction at this point. We're still significantly above the Fed's 2% target. And some have told me that markets may be accepting the fact that we are just in this 3% range higher for longer. Do you think bond traders believe that as well?
Well, I think that's what's being priced in, but I'm not naive enough to think that the Fed is just going to say, okay, we'll take 3%. I just don't think that that's something that they are willing to do. They basically have to change their mandate. So if you're betting on the Fed just throwing up its hands and saying, well, we can live with 3%, I think you're making the wrong bet. You're betting on too many rate cuts in this cycle. My guess is that the Fed is serious about getting inflation down to 2%, will accept some rise in the unemployment rate if they see that as creating enough slack to get the inflation figures to come down.
And Yahoo Finance got the chance to sit down with Rick Wurster, Charles Schwab CEO, and he said he's seen more retail investors looking into bonds. Kathy, I want to get your reaction to what he told us on the other side. Take a listen.
The other thing that's come up more recently that we're seeing from retail investors is a renewed interest in fixed income. Well, what's happened is with money fund yields coming down, investors are asking, hey, should we be in a bond strategy that has a little bit more duration to it so that we don't run into this reinvestment risk issue? So we are seeing bonds be of more interest to investors.
Hey, bonds a bit more interesting. Are you hearing the same thing from your clients, and what are you advocating for when it comes to positioning?
Yeah, we've been advocating for not sitting in cash for a long time because of that reinvestment risk that Rick mentioned. We also, though, don't want them to take too much interest rate risk and go too long in the yield curve. So we like intermediate term duration as an average duration, so which means you could spread it out and just end up with the average in that 5 to 10 year area. We think that that gets you enough yield without the reinvestment risk and without a lot of interest rate risk. And also, though, we're advocating staying higher in credit quality. It's not that we don't like lower credit quality bonds per se, but we're not getting paid a lot extra to take that extra credit risk. And if the economy slows down, we could see that underperform. So we like high credit quality bonds, government securities, investment grade corporate bonds, investment grade municipal bonds for people in high tax brackets in that sort of intermediate duration place, because we think that that's going to perform best in this environment.
And Kathy, you and I have talked before that if the bond market's boring, that's pretty good. That means things are going okay. If you start to see a lot of activity, though, that's typically a sign that something's not going right in this market, right?
Yeah, absolutely. Bonds will react if we have a big sort of change in the outlook. If it's a slowdown in the economy that even risks recession, you could see the long end really rally. If it's an acceleration that gets the employment numbers jumping back up and keeps inflation high, you're going to see a sell-off. So right now we're kind of in an equilibrium that's not too bad. And you can earn your coupon, maybe get a little bit in capital gains. It's a good environment for a bond investor if you're staying in the better credit names. But, that lack of volatility never lasts forever. We always have episodes. So, we'll wait and see what happens. We certainly have enough activity going on in Washington to give us the potential for volatility coming up in the next couple of weeks.
Yeah, plenty of risks heading into the end of the year. Kathy Jones, always a pleasure speaking with you. Thanks so much.
Thank you.
October effect refers to fears of a potential shock to markets over the course of the month, but generally tends to be positive for stocks, especially following a September that ends in the green, as the one that just ended did. Markets are pulling back today as the U.S. government is shut down. Actually, now little changed. But my next guest, seasonality could mean a monster rally. Here to break down what previous shutdowns and previous Octobers have meant for the market, Jeffrey Hirsch, Stock Traders Almanac Editor-in-Chief. Good to see you, Jeffrey. So,
how you doing, Julie?
I'm doing all right. There's a lot going on. Let's start with the shutdown and what we've seen during previous shutdowns that could inform what could happen this time.
I mean, it's kind of a nothing burger. If you look at it from the market's perspective, we've seen, the market with the scare of a shutdown head down a little bit into it, but there's usually other things involved. And we've seen rallies right afterwards. So I think even the overnight futures are sort of a microcosm picture of that, with, the being down a bit big early this morning and now bouncing back and market's kind of flat. So, the government shutdown is more jockeying for a position, more politicking than anything. It's not something that the market has historically had an issue with. Most of the time it rallies right after we hit that, either the low just before or right at the beginning of the shutdown. So markets don't really have an issue with it. The returns are pretty solid. Back in 2018, there was other issues going on. The last big ones that we had with the Fed cutting, we're not seeing that right here. And then early in the year, there was a whole lot of issues in 2018. For the most part, it's not so bad for the market. Yeah. And it's kind of move on. It's just news.
Or I guess it's not that relevant for the market, I guess.
Yeah,
the market's paying more attention to other stuff.
The market's looking at an AI tech boom and a monster Q4 rally here, and this is just some noise. And the Democrats, Republicans have to get on the same page and figure some things out and let them battle it out.
Well, the market may not care, but the people who aren't getting their checks during the government shutdown, they sure care. Right. But yes, point taken that this is not necessarily a market moving event. So let's talk about the things that you mentioned that are market moving events. And let's also talk about seasonality, which is something that you are steeped in, right?
Yes.
So
Born, bred, weaned, raised on it.
Yes, exactly. So September ended well. What do we tend to see in Octobers?
Well, I mean, you talk about the October effect. We called it October phobia. the fear of crashes and big sell-offs and massacres that we've had in October. But really, going way back to even the 1969 almanac that my late father put out, October's a bargain month. It's the best time to buy stocks. It's a bear killer. Best time to buy stocks, especially small caps and large caps. And we see a general turnaround sometime in the month, depending upon what happens. Coming into this year with the market being up for the 9 months and hitting 8 new all-time highs. Maybe it was even at 9 yesterday we didn't have one. In September, bearish September is bullish. When bearish seasonality doesn't happen, that's a bullish indication. We've seen one loss in 1967 in those years when we had all those new highs in September. We've got a worst 6 months period, the sell and May period that was also up at the second best worst 6 months ever. We've seen no losses in the fourth quarter, year-end gains, fourth quarter gains in the 6-7% range, year total gains over 20%. So we're looking at a potential for a monster rally, S&P 7100, and another 20% year for the S&P.
Wow, 7100 here. What could be the fly in the ointment? Is there anything that could change this outlook?
Well, there's always exogenous events, something in the Middle East and Russia and China, some systemic issue. But, the jobs number, people are concerned about that. And yes, employment is an issue, but a lot of it may be impacted by the lack of immigration and the things that are going on with that end of it. And, all the data that's out there. I did a whole chapter in my book, Super Boom, that I put out about inflation data being manipulated or at least adjusted. And there's all these economists doing things. If you just look at some of the, unadulterated data like jobless claims, I think you can get a good picture of where we're at. The economy, robust. And if you want to find out about inflation, just, step outside. Go to the store, see what things are happening. There's inflation out there. We all know that. There's shrinkflation, there's inflation. So the government shutdown with everybody worried about not getting their data, I think it's less of an event and more just something that's going to give us a nice little buying opportunity here in October and set up that, textbook October buy.
All right, 7100. You heard it here first, folks. Jeffrey, thank you. It's good to see you.
Thanks, Julie. Good to see you.
Key economic reports could vanish if a government shutdown happens, taking with them critical signals for the Fed. John Hilsenrath joins us to explain how missing jobs, inflation, and spending data could blink policymakers and what that means for markets and monetary policy. John, great to see you. So, all right, we're on government shutdown watch, John.
Yeah,
we're
seems
waiting.
Like we get one of these every
We sure
few
do.
years.
It sure does. But let's say it happens, all right? Everyone's placing their bets. If we saw that happen, that could mean, John, potentially what for the pace and publication of that all-important government data, the jobs data, the inflation data? What does it mean?
Well, it's the jobs data that really matters in this particular case, and also the next round of inflation data, because from the Federal Reserve's perspective, they meet again in late October. They only get one more batch of data before they have to make a decision about whether to cut interest rates again, right? So if we don't get the October jobs report, or if we don't get the October inflation report, they're flying blind going into the next meeting. It makes it a little bit harder to make a call that's already a little bit of a close call to begin with. Now, these shutdowns, they tend to wash out. They tend to be non-events for the economy and for the markets, but there's a little bit more at stake this time. And it's also, frankly, kind of hard to see what the incentives are for either side to compromise with each other on this one.
Could private sector data, John, fill in some of that gap or no?
No.
No,
I mean, we have ADP data, for instance, on the employment on the jobs front, but it's very often far away from where the BLS, a deeper, richer study tends to go. So, from the Fed's perspective, though, it's not necessarily going to take private sector ADP data to heart, but it's going to look at how the markets respond to a shutdown and how they're positioned going into the next meeting when they decide what they want to do.
So if you have the shutdown and, okay, now we have some interruption to the data, what does the Fed do in that situation, John, with the next meeting on deck?
That's what I'm saying.
Yeah.
It's a tough call for them to make with only 1 month of data before the next chance they get to look at. I mean, I think they take a lot of cues, not necessarily from private data like ADP, but from the markets. How are the bond markets behaving? What are the futures markets pricing in? What are forward markets pricing in for a move? The low risk thing to do would just be to stay on hold until you get to see more data. But if the markets right now are priced 90% for a rate cut in October, And if the Fed doesn't deliver something the market is expecting because it's flying blind, it could cause some turbulence.
Is John Hilsenrath at 90%?
No.
No, how come?
No. Because, if you listen to Fed speakers this week, the last few days, and if you listen to what Jay Powell was trying to say at the last Fed meeting, they want to have a little bit of wiggle room. There's still an inflation problem. It hasn't gone away. We had a couple of Fed speakers today, Beth Hammack, Alberto Musalem. They're still talking about, inflation is a percentage point above the Fed's 2% target. There's some aversion to going too far on this. Now, there's the Trump appointee, Stephen Miran, who's making an argument the Fed should do a succession of half-point rate cuts. He doesn't have the rest of the FOMC on board with him on that.
I saw an FT poll. I'm going to ask John about this. I got to get the Hilsenrath response. Did you see this one? They polled academic economists, all right? Overwhelmingly, they want Waller to succeed Jay Powell. That's what they want, John, 82%. But few think, according to this poll, he's going to get the job. Hassett, they say, Kevin Hassett is seen as the man most likely to head the Fed. What is your take on that poll?
It's funny you should ask that question because I do a survey myself with Duke University.
Did it dovetail with this?
In some ways, and it actually adds to it. I survey former Fed officials, former governors, former regional bank presidents, former senior economists there, ask them the same question. In fact, I think maybe the FT came after me. Ask them the same question. Unanimously, they say Chris Waller, and they also express some skepticism because they think he would be most independent. Not a single person voted for Kevin Hassett in my survey of former Fed officials. Yeah. So, and I think it's important for this reason. I think if Waller were to end up getting the job, you see economists saying this, you see former Fed officials. I think that's the guy that the markets would feel comfortable with. So to the extent there's some concern about Fed independence, the Fed's determination to get inflation back to, I think the market would feel comfortable with Waller. If Hassett gets the job, he's going to have to do a little work to build his own credibility, not only inside the institution, but with the marketplace.
John, great to see you. Thanks for coming on.
Thanks so much.